Hi trader, this is Chris from Elite Currency. Have you ever thought about whether your trading was based on luck or long-term viability? Well, the T Statistic is a very good tool for judging if your Forex trading is indeed long-term profitable. And I'll explain that in a second, but first of all, be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for all traders and investors. Therefore, please seek the advice of an independent financial advisor for more information on that. This video is for educational and informational purposes only, and by continuing watching this video, you agree with this risk disclaimer. So the idea about this T Statistic was actually explained in an article that I posted at Ad1 Markets. We offer, I think, good education, webinars, analytics as well, like wave analysis, and a very interesting Supreme Edition. So what is this T Statistic? Well, basically, it shows you the distribution around your average result. You see that dotted line here in the middle? That's the average result theoretically. Now, if you are, for instance, up in profit, what is the distribution that one could expect around that result? Just because, of course, a trader made 5% after 64 trades, does that mean you would make it again the next time, and then again the next time, and the time after that? Or will those results vary a lot? And will you next time hit minus 5% instead of maybe plus 4 or plus 3? So the smaller the distribution or the range around your average, the better, because the more sustainable it is. This is a T Statistic with 1.5, and you can see the results vary a lot. You know, sometimes minus, sometimes a small profit, sometimes big profit. So there's a huge range, which is not good, because that means that, you know, the results will vary a lot. This, on the next one, is a T Statistic of 3. And you can see that the results are a lot less dramatic. They're more stable and they're more viable. It's step by step going up, but nothing too crazy there. So that's better. And a T Statistic of 3, therefore, the higher, the better. So how do we calculate this? How do we calculate the T Statistic? Because that's something that will definitely help understand your trading. So pay attention. It's very important that you understand and do this and check how your trading is indeed performing. Alright, so we're going to go step by step through this T Statistic. Don't worry, you can pause the video at any time to go through things one more time. So, step 1, you choose a group of trades that you would like to analyze, whether weeks, months of your trading, or perhaps specific trades connected to a strategy. It is good to have a sample size of at least 30 trades, otherwise the results will not provide enough value. And basically the first step that you do is you take the results of each step, or each setup, in each trade. Very simply, you just count up the total of all those setups. So if, for instance, in this case, I have 30 trades and each of these is connected, has a result basically, I just simply count all these trades and have a total of 8.85. What I do then is I want the average. So I take that result and I divide it by the number of trades to get the average. That's pretty straightforward. Then I take the result of each setup and subtract it with the average. So for instance, the average here after dividing 8.85 by 30 trades is 0.00295. What I do then is I take the results and subtract 0.00295, the average, and I get this pink column, and that's the result in step 3. In step 4, I'm multiplying the result of the 0.3 by 0.3. So what that means is that I have these pink numbers, and I just actually multiply the 0.02705 in this case by 0.0275, just multiplying the same number to get basically these green numbers. That's the outcome by when one multiplies step 3 with step 3. Step 5 in that case would be to count the total of all 0.4. So that means that when I do have those 0.4s finally, I just count them all up to get step 5. So just basically adding all those green figures, and then I get step 5, which is the total. Moving on, dividing the average result, all right, we had that average, remember, by that 0.5, all right, that will be step 6. So basically, I have the average, which is this step 2 here, and I divide it by step 5, very simply gives me step 6. And then step 7 is the square root of the number of trades. That's step 7 here. So 30 trades, the square root of that is 5.48. And then the very last step, 0.8, is multiplying actually 0.7 by 0.6, and then we get the T statistic. So just simply 7 multiplied by 6 gives us 8, in this case 2.89. All right. Now be aware that a T statistic above 2 is good. That means that on average, the long-term viability, the long-term success rate of the strategy is positive. It seems like the strategy is built on long-term good foundation and not pure luck. If it's below 2, the outlook is less positive. It's still not maybe bad, but it's not as good as, definitely not as good as above 2. Anything below, between 1 and 2 will have to prove itself still. If it's less than 1, then the outlook is definitely not good. Now, the higher the better, obviously. So if one could get something close to 3, 4, 5, well, the higher the better, so that's great. But the minimum would be 2. If it's less than 2, it's, well, can you still, of course, try it, but realize that the T statistic has certainly its doubts when looking at that figure. All right, join us for a free 5-part webinar series over the next 5 weeks. Write an email to info@elitecurrency.com and join the list. And hope to see you soon. Good trading, and talk to you soon. Cheers.